Let's get across the market open now with David Scott, who's joining us from StoneX. Scotty, nice to see you this morning. Look, it's all happening when it comes to geopolitics, conflict in the Middle East. What are traders watching this morning?
I dare say, Nadine, and great to be here. The Truth Social feed from Donald Trump, probably first and foremost, is probably getting a lot of eyeballs right now. Lots of commentary out overnight, of course, in relation to Iran. And you can't go past that right now because that is the really dominant theme. In any other normal week, we'll be all talking about the Federal Reserve and how important that would be. But in this circumstance, it just pales in comparison.
So we saw oil up again through the overnight period by about 3%, even though we have not yet seen any disruptions to oil supply, to LNG supply. So does that cap the gains that we could possibly see?
Potentially. The one thing I really came across today when I was looking at the WTI contract for futures is that the 200-day moving average has been a really important focal point over the past week or so. The price went and broke through that level last Friday, and then came back to go and test it, bounced off it, and again, we did the same thing today, bounced off it and ripped higher. I just think that geopolitical risk premium that we might see something, particularly in relate to the Strait of Hormuz, is the exact reason why we're seeing that strength coming through. Whilst it's above the 200-day moving average and we have these headlines coming out, it's a buy on dips play, but obviously a very fluid situation and can change very, very rapidly.
Got it. So we'll be watching oil, obviously. It's the most obvious one for investors and traders to gain a sense of the heightened risk around those geopolitics, but also the US dollar index. So we saw it strengthen through the overnight period, presumably on safe haven flows. So again, where are we at critically when it comes to the US dollar technically?
Yeah, technically and fundamentally at the moment, well, I'm going to start with the fundamental picture as well. For a long period of time, the dollar has been on the back burner when it comes to those safe haven plays. But the thing that the dollar has over the likes of the euro, the Swiss franc, and the Japanese yen, which have been the go-to currencies, is that it's a big energy superpower. So if we do see energy prices spike really rapidly, it's in a better comparative spot than other safe haven currencies. So I think that's why, from a fundamental perspective, it's finding some support. But what you can see on your screen right now, this is the daily chart for the DXY. And you can see it's sitting at a really, really important technical level. 97.70 is a level it's done lots of work either side of. And you can see already it's gone and either approached it or tested on 3 times in this latest downtrend. Now, what happens over the next 24, 48 hours from a technical perspective is going to be very, very important. The way that pattern is coiling up right now, you'd say that the risks are that we're going to see a downside break. But clearly, if we would go and hold 97.70, then it would go and change the picture. And so maybe that would go and indicate the downtrend for the dollar is over. And then at the very least, we may be looking at sideways trade or potentially the start of a new bull market.
Okay, so a dollar is a watching brief. And I know that it's being overshadowed by the geopolitics right now. But this time tomorrow, we will be discussing the FOMC. The meeting started today. They've been armed with some data, retail sales, industrial production, import prices, which are pointing to softening in the U.S. economy. So what are we as traders, as investors, looking out for?
Yeah, when it comes to the Fed, it's going to be what it comes down to when it signals in terms of the number of rate cuts this year and next. Now, if you remember back to the meeting that we saw in March, and this is the projections that were sent out 3 months ago, the Fed was signaling the median FOMC member was expecting 2 rate cuts this year and 2 rate cuts next year. Now, the markets are wavering as to what the Fed might signal when it comes to this year. There's been a lot of talk about what this energy price spike might mean when it comes to the inflationary output. And will it go and see the Fed go and pull back on those 2 cuts and maybe go and only signal 1 this year and then maybe 2 or 3 next year? I'm definitely not in that camp. When you go and look at some of the information that's coming through, and you mentioned the retail sales weakness overnight, not just linked to fuel prices and autos, but other areas as well, it's softening. It's clearly softening up, including from the inflationary space as well. The one thing that's really struck me recently is that for all this talk about the import tariffs increasing both import prices, increasing producer prices, and producing and CPI prices, is that we haven't really seen any evidence to date coming through, nothing that's really meaningful at least. And so when you put that into the equation, you put softening growth into the equation, and just the geopolitical risk out there, I have no idea why the Fed would want to go and intervene and go and become more hawkish and to go and create even more uncertainty for markets. So for me today, It's going to be two cut signal for 2025 and two for 2026. Don't want to rock the boat today. Not the time.
Yeah, okay. Taking that on notice, Scotty, thank you. So let's talk about the ASX then. Expected to come under pressure at the open. No big surprise. But, you know, we had iron ore down, we had copper down. It just doesn't feel as if we're in a sweet spot for the ASX.
It doesn't. And we're extremely expensive, particularly when it comes to the financial sector as well. And you mentioned what's going on with iron ore. SGX iron ore is really on its knees right now, threatening to go and break to year-to-date lows. And when you look at the technical picture for the ASX 200 as well, this is the SPY futures contract. We've had a number of negative signals come through. We've had an evening star, which is a notable topping pattern. Then we're seeing the uptrend that the price was sitting in the channel broken. And when you look at what's going on with the momentum picture as well, it's not outright bearish at this point in time, but the really strengthening upward trajectory that we're on is now rolling over. So when you put those negatives together, it looks like potentially we could be due a bit of a pullback. I'm not expecting it's going to be anything really sinister in terms of the actual scale. We do go and see something that's a bit further to the downside, maybe 8280 or 8300 are the levels that I'm looking at. They both correspond with prior support levels and also Fibonacci levels as well. So they on the downside, the levels to go and watch. But we've had such a great run this year, just given the backdrop that we're dealing with geopolitically. Look, at some point, we're probably going to have a pullback, and that will be very, very beneficial over the longer term for this bull market to be sustained.